In today's fast-paced world, how do you quickly get to the real heart of a company's financial health and, its future prospects, especially when earnings reports feel so dense, just packed with jargon? It's a challenge, isn't it? Trying to stay properly informed. So our mission today is to tackle exactly that. We're going to do a deep dive into the Q2 2025 earnings analysis for FiscalNote Holdings, Inc. They're an interesting company, kind of at that crossroads of tech, government affairs, and legal info.
Yeah, and this isn't just like a quick summary. We're actually going to walk you through a structured five-part framework. It integrates FiscalNote's official numbers with real-time market expectations. The idea is to give you a really comprehensive, sort of nuanced understanding, cut through the noise.
Absolutely. You're going to get a shortcut to being genuinely well informed. We'll probably uncover some surprising facts, maybe have a few aha moments that clarify what's really driving their performance, beyond just the headlines. Okay, let's kick things off. Slide 1, the at-a-glance scorecard. This gives us that first snapshot of FiscalNote's headline performance for Q2 2025. We'll compare their reported figures against what Wall Street was expecting. First up, total revenue. FiscalNote reported $23.3 million. Now, that is a pretty significant decline, over 20% year over year from $29.2 million back in Q2 2024. They say this drop is mainly due to, well, strategic business divestitures and getting rid of certain products. But here's where it gets really interesting. Despite that big decline, the $23.3 million figure actually beat the consensus estimate, which was $22.8 million. So surprisingly, it counts as a beat on revenue. Okay, next, profitability. Their net loss was negative $13.271 million. That's a bit wider, about 4% wider than the negative $12.764 million loss in Q2 2024. So the loss got a little bigger. But then you look at diluted earnings per share, EPS. It came in at negative 0.008 cents, and that's actually an improvement of 11.1% from negative 0.009 cents in Q2 2024. The loss per share got smaller. So what does this all mean? How can the net loss get bigger, but the loss per share gets better? That sounds like a contradiction.
It does sound like one, and that's a really perceptive question. It's exactly the kind of thing that could, make you scratch your head. Now, for FiscalNote here, their basic and diluted EPS were actually identical in both periods, negative 8 cents and negative 9 cents, respectively. So no major impact from potentially dilutive things like stock options. But to unpack that apparent contradiction, better EPS despite a bigger net loss, it really comes down to two main things. First, FiscalNote got significant benefits from really buckling down on expenses and efficiency. Their total operating expenses dropped by a hefty $6.5 million. That's 18% year over year. And it wasn't just one area. It was across the board: cost of revenues, R&D, sales and marketing, even editorial. Pretty effective cost control. The second factor is, well, the share count. That per share improvement happened even though the number of weighted average shares used for the calculation went up quite a bit. It rose 19% from about 134.4 million shares in Q2 last year to 160 million in Q2 this year. So for the loss per share to actually shrink with more shares out there, it really highlights just how effective those cost cuts were on a per share basis. That widening of the overall GAAP net loss, despite the better operations, that points towards non-operating stuff. Things like interest expense, maybe gains or losses from selling assets, things that hit the GAAP bottom line but aren't about the core day-to-day business performance.
Right, that's a crucial distinction. So given all that complexity, how did the market react right after the numbers came out? Did they see past that headline, EPS miss?
Well, the immediate reaction was pretty typical. FiscalNote stock dropped about 2.47% in after-hours trading. The market often focuses on that headline EPS number first, even with a revenue beat. Analyst sentiment initially seemed, well, mixed. Maybe cautiously optimistic is the right phrase. They definitely acknowledged the revenue beat. That was a positive. But the EPS miss and the ongoing slide in annual recurring revenue, or ARR, those were definite concerns. But importantly, analysts also pointed to some positive operational signs: the cost cuts, the divestitures cleaning things up, and signs of life in their new PolicyNote platform. Plus, management sounded pretty optimistic about the second half of 2025, and that seemed to temper the reaction a bit. They were trying to look beyond the immediate quarter.
Okay, so you've got the scorecard. Let's peel back another layer now. Let's see how FiscalNote is actually converting revenue into profit. Time for slide 2, the engine of profitability. We'll look at their ability to turn sales into profit, focusing on those key margin trends. Our gross profit, it did decline from $22.4 million last year to $18.3 million this quarter, but And this is interesting, their gross margin actually improved, went up from 77% to 79%. Similarly, their adjusted gross margin ticked up slightly, 85% to 86%. So that suggests they're getting, more efficient at managing the direct costs of delivering their services. Okay, but then we look at operating loss. It improved slightly in dollar terms to negative $7.427 million from negative $7.956 million, a small improvement, but the operating margin actually worsened. It went from about negative 27.2% down to negative 31.9%. So wait, gross margins improve, but operating margins worsen. How does that work?
That is precisely what jumps out, and it really underlines that crucial difference between GAAP generally accepted accounting principles and non-GAAP measures. GAAP gives us that standard, comparable view, which is essential. But non-GAAP measures, things like adjusted gross profit or adjusted EBITDA, are what companies use to try and show, let's say, a clearer view of core business performance. They do this by backing out certain items, often things that are non-recurring or non-cash expenses. And for FiscalNote, this is where the story gets really interesting. Their adjusted EBITDA, that non-GAAP figure, showed a really significant improvement. It jumped from $1.8 million in Q2 last year to $2.8 million this Q2. And here's the real kicker. Their adjusted EBITDA margin doubled, went from 6% to 12%. That's huge. The main things they add back to get to adjusted EBITDA are interest, taxes, depreciation, amortization, but also things like gains or losses from selling businesses, stock-based compensation, severance costs. So you see the GAAP numbers are hit by these restructuring type costs, but the underlying operational profitability measured by adjusted EBITDA is actually getting stronger.
Okay. So this big contrast, the GAAP net loss widening, operating margin worsening, but then the significant jump in non-GAAP adjusted EBITDA. It really paints a picture of FiscalNote's strategy, doesn't it?
Exactly. It's a deliberate trade-off they're making. They're actively selling off non-core assets like we talked about, and they're cutting operational costs quite aggressively. Those actions, like divestitures and restructuring, often bring one-time charges that hurt the GAAP numbers in the short term. But the adjusted EBITDA improvement shows that their core ongoing operational profitability is actually getting better. They're aiming for a leaner, more streamlined business focused on stronger underlying profit, even if it means taking some hits on the GAAP statement during this transition. It's strategic.
Okay, let's pull back the curtain even further then. Next up is slide 3, the engine room business segment performance. This is where we get into the nitty-gritty, looking at FiscalNote's different revenue streams and some key operational metrics. See how those strategic shifts are playing out.
Right, let's break down the revenue sources. Subscription revenue, that's their main engine. It declined 21% year over year, dropped from $27.1 million in Q2 2024 down to $21.4 million in Q2 2025. They said this was primarily due to those divestitures we keep mentioning. Even if you adjust for those, using pro forma numbers, subscription revenue was still down 8%. And their advisory, advertising, and other revenue, that also decreased by 10%, went from $2.1 million down to $1.9 million. Again, mainly because they stopped some non-strategic products.
Yeah, and it's really worth hammering this point home. These declines are basically the planned result of their strategy. They are intentionally cutting parts of the business that don't fit the long-term plan. It looks like shrinkage, but it's really strategic pruning. Okay, so for a subscription business like this, there are some crucial KPIs, key performance indicators we need to look at. First, annual recurring revenue, ARR. This is basically a snapshot of the predictable revenue they expect over the next year from current contracts. As of June 30th, 2025, FiscalNote's ARR was $85.9 million. That's down significantly, 21%, from $109 million a year ago. Even the pro forma ARR was down 8%. That's a concerning trend for a subscription model, right?
CF and grazes eyebrows, yeah.
Then there's net revenue retention, NRR. This tracks how much revenue you keep from existing customers, accounting for upgrades, downgrades, and churn. Ideally, you want this over 100%, meaning your existing customers are spending more over time. FiscalNote's NRR was 96% this quarter, down from 98% last year. Pro forma NRR was also 96%. So being below 100% means they're losing slightly more revenue from existing customers through churn or downgrades than they're gaining back through upgrades or price increases. That directly feeds into the ARR decline.
And FiscalNote themselves point to a few reasons for this. They mentioned previously known execution challenges, some customer engagement issues with older products, and even cited atypical instability in the U.S. federal sector as headwinds. So they acknowledge the issues.
Okay, so ARR down, NRR below 100%. It sounds like a difficult picture for their core business metrics. But countering that, management did highlight several positive operational developments. What were those, and do they offer a real counter-narrative?
This is where it gets really interesting, and it leads to that question. Is FiscalNote hitting an inflection point? Because while those metrics, ARR and NRR, are definitely negative right now, You could argue they're lagging indicators. They reflect past sales issues, retention problems, the divestitures. But management pointed to several leading indicators, things like improvements in inbound sales leads and sales pipeline. Also, higher user engagement metrics on its new FiscalNote platform and improvements in key sales metrics for new corporate logos.
Wow.
And maybe the most telling point, they said new corporate customers signing up for policy info were doing so with multi-year deals at more than double the rate seen just last year. That's a strong signal.
Ah, so lagging versus leading indicators.
Exactly. These leading indicators suggest that maybe, just maybe, the strategic changes are starting to gain traction. If these positive trends hold, it backs up management's explicit guidance for a return to ARR growth in the second half of 2025. So, for you listening, watching things like policy note adoption and new customer wins in the next couple of quarters becomes really crucial. That's where you'll see if this turnaround story has legs. It's about shifting focus from the rearview mirror to the road ahead.
That's a great way to put it. Okay, now let's shift gears slightly. Let's turn to slide 4, financial strength and shareholder rewards. Here we'll look at FiscalNote's balance sheet health and how they're thinking about returning capital to shareholders, if at all. All right, liquidity first. Cash and cash equivalents actually increased. They ended Q2 with $34 million, up from about $28.8 million at the end of 2024. So their cash cushion improved. However, total assets declined, went down to $288.3 million from $326.2 million. So more cash, but fewer total assets. How does it work?
Well, that drop in total assets is, again, a direct result of selling off those business units. We talked about Timebase, Oxford Analytica, Dragonfly, ISIL. When you divest businesses, your asset base shrinks. It's just part of that strategic refocusing. Not necessarily bad, just different.
Got it. Okay, now let's look at debt. Uh-oh. Current maturities of long-term debt, that's debt due within the next year, it jumped significantly. Went to $6.5 million from almost nothing, just $36,000 at the end of last year. But interestingly, their long-term debt, the portion due after 1 year, actually decreased, dropped to $110.2 million from $147 million. And overall, their total liability saw a pretty noticeable reduction, down to $190.5 million from $228.4 million. Total stockholders' equity dipped slightly. So how do we piece together these debt movements? More due soon, but less overall.
Yeah, it looks a bit confusing at first glance, but it's actually a sign of pretty active debt management, likely tied to that restructuring. The key metric here is the debt-to-equity ratio. It measures how much debt they use compared to shareholder equity. And that ratio actually improved. It went down from about 2.33 at the end of December 2024 to around 2.00 at the end of June 2025. A lower number is generally better, suggesting less financial risk. So they're relying less on debt relative to equity, which is positive for long-term stability.
Okay, so the improvement in debt to equity is good.
Right. And that reduction in total liabilities and long-term debt, that comes directly from using proceeds from those asset sales to pay down debt. Remember, the time-based sale brought in $6.5 million. They used that and proceeds from other sales to pay down over $27 million in principal debt just in the first half of 2025. So they're actively deleveraging. Paying down debt reduces their interest payments, gives them more financial flexibility, and moves them closer to that stated goal of durable, positive free cash flow. It's about building a stronger foundation.
Makes sense. And what about returning capital to shareholders? Any mention of dividends or share buybacks in the release?
No, nothing mentioned. And that's very typical for a company that's in this kind of significant transition phase or even just a growth phase. Their priority right now is clearly reinvesting cash back into the core business, getting leaner, and strengthening the balance sheet by paying down debt. Things like dividends or buybacks usually come later once they achieve more stable, mature profitability. Plus, that increase we saw in weighted average shares confirms they weren't buying back stock.
All right, that brings us to the final section, slide 5, the road ahead management's outlook and key takeaways. Here we'll bring together what management is saying about the future and boil down the key messages from this quarter for you. Okay, CEO and President Josh Resnick sounded pretty positive. He said Q2 performance demonstrates the progress we're making in strengthening our business and positioning FiscalNote for durable, profitable growth. He specifically pointed to encouraging signals in our product and customer metrics, with policy note adoption and engagement building momentum. And looking ahead, management expressed confidence in a return to ARR growth in the second half of 2025, as well as continued margin expansion. They also reaffirmed their full year 2025 guidance. Total revenues between $94 million and $100 million, and adjusted EBITDA between $10 million and $12 million. For Q3 specifically, they're guiding for $22 to $23 million in revenue and about $2 million in adjusted EBITDA. And they mentioned the board is still reviewing strategic options, though no promises or timeline. So what does all this tell us about how confident management feels about pulling off this leaner, more focused strategy?
Well, these statements sound like a pretty clear declaration of conviction, don't they? They're essentially broadcasting, look, we did the hard part, the restructuring, the cost cuts, and now we're starting to see positive signs in the core business. That explicit forecast of returning to ARR growth in the back half of this year is a bold statement. It really puts the pressure on them to execute over the next 6 months. They've pivoted the strategy, and they clearly believe it's going to work. Okay, so let's distill this whole complex quarter down into some key actionable takeaways for you, the listener. First takeaway. Strategic transformation is definitely underway. FiscalNote isn't just drifting. They are actively, deliberately reshaping the business, selling off pieces, cutting costs hard. This leads to that improved adjusted EBITDA even while the top line shrinks. Remember, that's an intentional trade-off, focusing resources on core, higher margin activities. Think of it like pruning a tree for better long-term health.
Right, the pruning analogy works well.
Second, we might be at an inflection point for growth metrics. Yes, ARR and NRR are still down. Those are the lagging indicators reflecting past issues and the divestitures. But those leading indicators, sales leads, policy note engagement, those multi-year deals for new logos, they suggest a potential turnaround is brewing. Management is betting on it with that H2 2025 ARR growth forecast. So watch those leading indicators closely. Okay, keep an eye on the leading indicators. Third takeaway. They are strengthening their financial foundation. Selling assets to pay down debt is actively deleveraging the balance sheet. We saw the improved debt-to-equity ratio, lower total liabilities, more cash. This isn't just about reducing risk. It gives them much more financial flexibility and makes achieving that durable positive free cash flow goal more realistic. It's foundational work.
Makes sense. Building a stronger base.
And finally, the mixed market reaction reflects this transition. That immediate stock drop shows the market sensitivity to the EPS miss and those declining subscription numbers. But the somewhat cautious optimism from analysts acknowledging the strategic efforts shows it's not all negative. It just highlights how complex it is to evaluate a company going through such a major overhaul. Short-term GAAP results are messy because of the long-term strategic moves.
Absolutely. So as you can hopefully see, going through this structured analysis helps you move way beyond just the headlines. You get a much deeper feel for what's actually driving the company's performance, its financial health, and what management is thinking. And this method, you can apply it again and again.
Definitely. And maybe a final thought to leave you with. Given FiscalNote's very deliberate shift, getting leaner, focusing the business, aiming for that ARR turnaround in the second half, what does this whole case study suggest about the value of long-term strategic transformation versus just focusing on short-term headline performance, especially for companies trying to grow? Something to chew on.
Indeed. And before we wrap up, the important disclaimers. Please remember, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. The information here is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should absolutely be made based on your own research and in consultation with a qualified financial professional. While we strive for accuracy, no guarantee is provided. This report was generated by an artificial intelligence model, integrating data from the company's official press release and public market data via web searches. Although the AI follows strict data protocols, errors or omissions might still occur. Please independently verify all information, including financial data and calculations, before making any decisions based on it. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.